The Indian rupee is facing turbulent times. As of January 20th, 2025, it stands at 86.62 against the US dollar. This represents a 2.12% fall since December 10th, 2024. The rupee even hit a historic low of 86.70 on January 13th, 2025. This marked its steepest single-day fall in nearly 2 years. This downward trend is not new. The rupee has been depreciating for 7 consecutive years. In 2024 alone, it fell by 2.8% against the US dollar. The last quarter of 2024 saw the most significant decline. The rupee depreciated by 2.2% during this period. It even reached an intraday low of 85.81 on December 27th. This consistent weakening of the rupee is a cause for concern. It reflects underlying economic challenges and external pressures. The falling rupee impacts various aspects of the Indian economy. Imports become more expensive, potentially fueling inflation. It also affects the affordability of foreign goods and services for Indian consumers. The depreciation can also impact businesses that rely heavily on imports. Understanding the reasons behind the rupee's fall is crucial. It helps policymakers formulate appropriate responses. It also provides businesses and investors with insights to navigate this volatile period. The Reserve Bank of India, or RBI, plays a crucial role in managing the rupee's exchange rate. Traditionally, the RBI has intervened in the forex market. It bought or sold dollars to stabilize the rupee and curb volatility. However, the RBI has recently shifted its strategy. It is now allowing the rupee to fluctuate more freely. This policy shift is a deliberate move. The RBI aims to conserve its foreign exchange reserves. It also recognizes the influence of a strengthening US dollar. The RBI's reduced intervention contributes to the rupee's recent decline. However, this approach is not without risks. Allowing the rupee to fall freely can lead to a sharp depreciation. This can create uncertainty in the market. It can also negatively impact investor sentiment. The RBI is walking a tightrope. It needs to balance its intervention strategy. It wants to manage the rupee's fall without depleting its reserves excessively. The RBI's policy shift reflects the changing dynamics of the global economy. It also highlights the challenges of managing a currency in a volatile global environment. The success of this approach remains to be seen. It will depend on various factors, including the US dollar's trajectory. The rupee's depreciation is not solely due to the RBI's policy shift. Several external and internal factors contribute to its weakness. The strengthening US dollar is a major external factor. The US dollar has appreciated against most major currencies in recent years. This makes the rupee weaker in comparison. The recent US presidential election has further strengthened the dollar. Donald Trump's victory in November 2024 triggered a surge in the dollar's value. This has had a spillover effect on emerging market currencies, including the rupee. Apart from the strong dollar, structural issues within the Indian economy also play a role. India has a persistent current account deficit. This means the country imports more goods and services than it exports. This deficit is primarily driven by oil and gold imports. It puts downward pressure on the rupee. Another concern is the widening trade deficit. This indicates that the value of imports is increasing at a faster rate than exports. This imbalance further weakens the rupee. Furthermore, India faces a domestic liquidity deficit. This is partly due to the RBI's intervention in the forex market. The central bank selling dollars absorbs rupee liquidity. This makes it more expensive for banks to borrow money. These external and internal factors create a challenging environment for the rupee. Predicting the rupee's future trajectory is complex. It depends on a multitude of factors. These include global economic conditions, the US dollar's movement, and domestic policy decisions. However, expert predictions provide some insights. Many analysts believe the rupee could further depreciate in the coming months. Some predict it could fall to 87 against the USD by March 2025. The policies of incoming US President Donald Trump will also play a crucial role. His administration's stance on trade, fiscal policy, and foreign affairs could significantly impact the dollar's value. India needs to address its structural economic weaknesses to mitigate the rupee's fall. This includes reducing the current account deficit and boosting exports. Attracting foreign investment can also help stabilize the rupee. The government can achieve this by implementing business-friendly policies and improving infrastructure. The road ahead for the rupee remains uncertain. However, proactive measures from the RBI and the government can help navigate these turbulent times. India needs to strike a balance between managing the rupee's fall and addressing its underlying economic vulnerabilities. This will be crucial for ensuring economic stability and sustainable growth in the long run.